story because a lot of regulation is going to be shaped based on what happened in this particular situation. So traders use models to determine fair value, and what they do is they say, given these quantitative inputs and given maybe these fundamental bits of information that we have about the value of the underlying lines of business, we can come up with a fair value where a stock or something should trade, and we buy and we sell around that. But then every now and then, something goes wrong. And in this particular example, this is a Chinese lumber company that it turned out had no trees. So this is corporate fraud right here. But you see this kind of thing happen in airline stocks when they lose a plane. You see it happen in drug stocks when they miss things. So a lot of trading is managing risk, and one way you can do that is with derivatives. So this is a really simple graph. This is basically a put option and stop. When the stock price declines, the put price goes up, and so you're stopped out, right? Your max loss is just what you paid for the put. So you always have downside and understanding of what's going to happen on the downside. So JPMorgan. They have a huge portfolio. They have a very complicated book. The Volcker rule says that they're not allowed to proprietary trade, but they can hedge that book. They can try to lay off their risk, right? So this is a super complicated portfolio, but the majority of it, $1.1 trillion in customer deposits, so this is your money and mine, they invest in high-grade corporate bonds, which makes sense, because this is how they earn interest, and then that interest is in turn paid out to you, and they keep the spread. But there's risk in those corporate bonds as well, even though they're highly rated. So you see, these are the kind of companies we're talking about, which, you know, you can see some of them are bankrupt now, but the broader problem is actually the systematic risk. It's what happens if every single thing in that portfolio goes to hell all at once. And so what you do to hedge that is you use a derivative called a credit default swap. What you hear about in the news is this, this horrible thing, but it's really simple. It's, I need protection for my bonds, I pay you to give it to me. If that bond defaults, you pay me the par value of the bond. And it's a lot like buying insurance. But you don't really want to buy CDSs on all of these individual positions you have on. You want to buy broad protection through the form of an index. And so that's what they're doing. They're buying short-term protection on this entire portfolio. What they're trying to hedge against is not only that systematic risk, it's also the risk of European contagion, right? Except that didn't actually materialize in April of this year. So they found themselves with too much protection, and they said, oh shit, we're paying so much money for this, let's take it off. But instead of doing the smart thing and actually reducing the protection that they had bought, they decided that they were going to sell long-dated protection. So this is a credit default swap index that's expiring 10 years out, actually in 2017. And so what they're basically doing is they're selling long-dated insurance, collecting a premium, and then in turn they're long short-term insurance, which is called a curve flattener trade. And this is actually one of Italian debt, and you can kind of see here that in the near term Italy is kind of like effed, but in the long term they're hopeful, right? So the problem is, as you're doing these trades, what you're doing is JPMorgan sold so much of this index that they started fundamentally affecting the value of the index relative to the things that made up the index. And so when that happens, you see these weird divergences happen. Okay, and so then hedge funds see that too. And they say, hey, wait a second, this is not a fairly valued asset, just like we were talking about in the beginning. This is not a fair value. We should buy this because this should converge and ultimately we should make a profit. So that's what they did. They put it on bigger and bigger. Except the problem is the trade didn't converge because JPMorgan has a massive balance sheet. And so what they were able to do is they just kept selling that index. And they kept selling it, and the hedge funds get pissed and they say, what the hell is going on? There's no regulators we can complain to, so we're going to complain to the press. And so they go to the press, and that's where you get the London Mail story, and that's where you get the Voldemort from, and all that other stuff. But ultimately, that's how Jamie Dimon kind of found out that his CIO was doing some stuff that maybe they shouldn't have been doing. They were hedging their hedge instead of reducing their hedge. And the end of the story is not really written yet, because if you follow the news, ultimately this is still what's called a mark-to-market loss, which means they haven't actually been able to turn around and liquidate these positions. The hedge funds are still kind of trying to force them out of it. Everybody knows what position they have on. You saw this happen in long-term capital and Amaranth. It's a hard thing to work out of. But what I want to get at here is actually that the problem isn't hedging. This particular hedge was just a gargantuan fuck-up. But for the most part, it's actually, you want your banks to be hedging. You want this to be happening. And this is what JPMorgan looked like after the news broke. But the point is, you really want regulators not to be combing through books looking for hedges and saying, is this a hedge, is that a hedge? Because the bigger problem here is that JPMorgan still has a balance sheet big enough to put that kind of sell pressure on and actually distort the market. And this is really still ultimately a problem of too big to fail. Because you can't lose $2 billion if you don't have the capital base to put on a bet that big in the first place.